Good morning, guys. How are we all doing? I'm Dan from Trading with Dan. This is our Bitcoin morning update. Happy Friday, everybody. Hope you've all had a great week. We shall now go straight over to those Bitcoin charts. Yes, the Bitcoin on the 4 hour. Bitcoin on the 4 hour. Obviously, continuing that move to the upside. And basically sort of holding up. Just above our resistance zone, as you can see. This been, just to extend this along, this been the top of it, and this been the bottom. We did have a nice wick down, actually, literally to the actual tick. On the lower side of the well, you could call it resistance or support. I mean, we're trading within it, but yeah, the lower side of that range, and then bounced off it very nicely back above, and looking quite good here. We have obviously got opposing forces of are we forming a potential bull flag and then another leg up, or are we in the context of a lower high relative to the high here, and well, obviously the high we've got all the way over there, but yeah, what we may do just for fun is drawing a trend line. We'll actually get rid of these ones. Just a kind of a wedge that we were kind of looking at that didn't it could have been a wedge, but either way we did break down to the downside. But yeah, we'll take that out. It's messing our chart up a bit. We'll extend this along a bit. I'm not sure why this line is a bit brighter. Maybe it's a different color white. Yeah, that's why. We'll draw this line in here, and yeah, I mean, I guess that could be our target to break above. But maybe we'll have a third touch of it though. Maybe we will at some point today, or maybe over the weekend. Lots of maybes there. Break up into our actual next zone. This $47,000 potential resistance area, obviously with all this price confluence, and then obviously hit that downward sloping trend line again. Maybe we make one move back down. Maybe it takes us basically back into this support area, and then well, we can either continue down, or we could then formally break that trend line around here and then have a nice move up back ultimately towards the top of the range. Or do we just come straight up to it and break above now, break through this area, break above it now, accelerate through 48,000, and then it just look good for a tap of the top of the range. At the end of the day, as I'm kind of saying, I have been looking for us to establish a range, try and ascertain those levels, and then ultimately we ping pong from top to bottom, bottom to top, top to bottom, bottom to top. But obviously the process that we do so is a meandering fashion, obviously interacting with usually the 3/4 area, so obviously the lower quartile, the midpoint, the upper quartile, and the top. But yeah, that's kind of how I'm looking at this. We are clearly in an area fraught with peril so far as lower highs. Obviously lower highs within this small iteration of price action, obviously lower highs within this being a lower high relative to our larger overall macro move. I mean, there are lots of forces at play. I do feel price action Bitcoin was constructive with what it was doing and looking good for a retake of the all-time highs and continuing upwards, but we had the Evergrande situation sort of first spanning the works. I mean, we can see in the stock markets, it made the stock markets take a very deep correction, deeper than their previous corrections. And Bitcoin actually didn't take a correction deeper than its previous corrections. Bitcoin literally just came to the bottom of the new, ideally in fingers crossed, the new trading range bottom, with obviously the bottom of that being the high of the previous trading range. So it is not as bad out there as it could be, but clearly there are there is a certainly a bear case. But when it all comes down to it, it all does come down to well, ultimately all these asset prices priced in dollars, basically in Fed fiat coupons. It all just comes down to liquidity. I mean, liquidity is the correlation. Liquidity is what everything is correlated to. I mean, liquidity drives the stock market, liquidity drives the crypto markets. It is liquidity which is the correlation, which is the causation, and then obviously the correlation. That's where the correlation between crypto markets and stock markets come from. That is just a correlation, and obviously the saying goes, you don't confuse correlation with causation. Causation is the liquidity, but we are potentially coming into a bit of a liquidity trap coming into the end of the year. There are just liquidity problems with the Fed potentially going to start with its well, you can call it tightening or tapering, but just basically lesser easing. But there is an interesting aspect to that we'll just quickly discuss here. Is the Fed did make comments that it wouldn't take a really good number, jobs number that is, to basically start the tapering, which is therefore implying they would start it with just average, just the normal trundling along job numbers. So the market is looking at that. The market is looking at that as potential tightening sooner then. But I kind of feel like what is really happening, and maybe this is like it's not a bit conspiratorial, but it's a bit like second layer. It's a bit like you get Occam's razor, where basically the less assumptions you make, the better. But if I just add in one extra layer of assumption, it feels like the Fed is basically giving itself a bit of a get out sort of statistic to then allow it to continue with its easing. If we then basically get bad jobs numbers, which I think that obviously the jobs numbers are heavily manipulated anyway, with the birth death models and just the actual labour force participation rates, and they are heavily manipulated figures. So all it then takes is the jobs number to get manipulated for the Fed to keep doing what it wants, and it kind of looks like the Fed is just then reacting to the jobs numbers in a way that it said it would, rather than the Fed just not wanting to ever do any tapering. So I think structurally the job market is in a bit of a mess. There are very new I think secular rather than cyclical trends in the job markets. Basically, lots of people have been forced into getting used to working from home, and they realize that the office is just so outdated and unneeded for a lot of jobs. Those people also, I mean, they're happy at home with their hours, their flexible hours, they're staying at home with their family or their cats or whatever they do. Also, potentially people moonlighting with second jobs that the bosses don't know about. No smelly trains or public transport commutes, no rush hour traffic. Life is better for a lot of these people at home. They're not wanting to come back to the office. Things are going to have to change. Also people are getting heavily incentivized not to work. I mean, inflation is higher. It is then a lot more expensive to get people to take certain jobs, and especially if they want them to take them in the office. So I mean, there are lots of things that are gonna be resistant to good jobs numbers, basically. Yeah, I mean, maybe the Fed is just basically just opening a door for itself to give it an excuse to basically continue with what it wants to do. That's my view on it. Obviously, the other market financial professionals, more professional than I am clearly, are viewing it as basically tapering sooner, because they then just look at the jobs numbers and expect better job numbers. But I question the job numbers full stop. They're just a manipulated statistic, heavily manipulated statistic. But then also it's just like, well, they then just have to manipulate the jobs number to continue with the easing, and I think that's what may happen. So either way, so there is a potential liquidity trap, liquidity problem going into the end of this year. But I actually think the Fed is finding new ways to basically just carry on with its liquidity, because it kind of ultimately knows what's going to happen. It can't actually do anything. It just has to pretend to project power rather than have any actual power. But yeah, we have gone on about that very much too long. Also people looking for extended downside in the stocks. There is a lot of protection out there, a lot of basically options protection to the downside, and that is not when markets crash. When there is that protection, they crash when the markets are euphoric and no one is protecting to the downside, and number only go up. So there are lots of reasons to expect, I think, actually a very bullish ending to the year, even though the Fed is just trying to calm things down a bit. Yeah, if we want to kind of look at some other charts as well, because clearly we do. The Ethereum Satoshi pairing, it basically tried to regain that neckline of this ascending triangle, failed, and is now in at an important level of support again. So does it bounce here? Obviously an important level here. Does it bounce here, or do we break down? I mean, this is clearly looking a bit worrisome and bearish. So yeah, I mean, there we go. We could trade below this horizontal, lose these levels and trade lower. Obviously an accelerated move in Bitcoin either to the upside or the downside will pretty much precipitate that. But I guess if Bitcoin is just going to kind of drift sideways and up here, then yeah, I mean, that will potentially actually bounce this. But I mean, again, it just depends on what Bitcoin does. The Bitcoin dominance, again, similarly looking like it could make a move back above this basically the area, in which case we could be looking at more upside. So we've got to keep an eye on that. The 10-year is making interesting moves. I think the 10-year is potentially reacting to the reduction, the perceived reduction of liquidity going forwards into the end of this year, by obviously increasing the cost of basically increasing the rates, because the cost of funding then of the government, the US government, is then potentially going to increase if there isn't as much liquidity wanting to fund the government. So yeah, rates are increasing. Also, interestingly enough, obviously, I mean, it's kind of an obvious statement that as these rates go up, then these investments become more attractive, because there is a lot of cash and cash equivalents on the sideline that basically don't particularly want to buy government bonds, just because of how much below inflation they are yielding. So obviously, if we do get an increase in this, then obviously the government can all of a sudden, well, it can find more cash wanting to come in and fund them. But then obviously the flip side is they're then going to be paying a high level of interest, which is a bit difficult, which is a bit troublesome on the amount of with the obviously just the sheer amount of debt that they've got, like basically all household, corporate and obviously government. But yeah, I mean, we are basically approaching this top level. So if we do a break above here, then yeah, things can start to look a bit more difficult going forwards. I mean, it is a sign of inflation. It is basically, if we are in a weakening economy, which we're clearly in a substantially weakening economy, then it is a clear sign of stagflation. But as far as commodity prices are concerned, of which Bitcoin is pretty much classed as, then that is good for those asset values. So yeah, so we could still be okay even in that scenario. There is what else I want to say. There's something else I wanted to say. There is a problem. There is a what was I going to say? Yeah. There is a problem structurally with the economy, because obviously in all previous financial crises, they've always been financially centered crises. Not even a real word, but you understand what I'm saying. And throwing money at it has been a perfectly acceptable problem to patch holes in the finances of banks or corporations or whatever. But this time is different. This global pandemic is fully different because the money has for the first time ever been printed and actually dished out to the general public, real people. There has been a substantial amount of economic destruction of small businesses, and many of these small businesses, they will not start up again. People just don't have the actually the capital to even just restart. A lot of businesses that have shut down, wages are a lot higher because people are not wanting to work. People because of the inflation, people have less money. Basically these global lockdowns have literally wrecked the real economy, and this is the real economy. This is not like when we have the 2008 financial crisis, and there's holes in government, there's holes in not government, there's holes in investment banks' balance sheets. This is not like when we obviously have AIG and there's holes in reinsurance balance sheets, or mortgage lenders' balance sheets. These are holes in people's balance sheets that basically can't restart or can't basically set up businesses. And obviously in a state of rising inflation, it's just a disaster. There's something we've got to think about there. Things are different this time. Is that famous saying? It's different this time. It is different this time. It is not. Basically, they've hammered hard the real economy. And this is not just some sort of financial. This is not like a ledger problem. The problem with the assets, and the Fed prints it, that money stays in the financial, within those financial institutions, and doesn't hit Main Street, doesn't hit real prices on the street for real people. This is different this time. This is different this time, basically. So yeah, we've got a lot of problems. We have got a lot of problems for which the Fed is not going to be able to stop what it is doing. We are in, as I repeat on numerous videos, in a Ludwig von Mises Austrian School of Economics crack up boom. Just search crack up boom. That is literally what we are in. We are in a crack up boom, and yeah, the Fed can't tighten into that. And that's that. So yeah, there you go. Let's have a look at stocks. How are they doing? Have had obviously a nice push up, almost hit into the underside of that trend line before easing off, but clearly we have to be expecting just more upside for this. I say clearly, it isn't clearly, because this could obviously be a lower high and we could turn this back around. But do I think it's going to happen? No, just because of all the things I just said. Nonetheless, sideways within this range, potentially printing a sorts of inverted head and shoulders before breaking up is certainly on the cards. But yeah, sideways in this range wouldn't be. It's not necessarily going to be the worst thing anyway. The DXY, after its crazy pumps up, is showing sign of rejection and weakness. It's showing sign of struggling to get break above here. But ultimately, we've just got to watch the levels. We are near to the low side. We break back below into this range, then yeah, I think we will resume the downward trend. If we break back above here, then well, I think we stay in a downward trend longer term, but I think we then have a shot of tapping up here, tapping the upside of the ascending broadening wedge, or the trumpet formation. So yeah, other than that, not too much I want to look at. Clearly gold is going to get whacked with these bond yields rising, as you can see, coming down below important support. I don't bother looking at this too much anymore. So let's have a look at the stochastics. We do know we were looking at these 10-12 round daily to turn up and give us some momentum. Obviously 4 hour extended with getting us up to where we got to. The 10 hour is going to be moving up nicely when it decides to load. Moving up very nicely, getting towards the bullish half. Plenty of 10-hour stochastic momentum to aid us to the upside. 12-hour turning up as well, moving up from a below level. So it's got all to play for. It's got the full field to run into, and yeah, can easily get us up to that $47,000-$48,000 level, and then we have to make some important decisions there. Daily looking to turn back up as well from a relatively low level. 2-day turning up as well from a relatively low level. 3 days still diving. 5 days still coming down. Weekly still up there. Bi-weekly still pointing upwards as well. So stochastic read alone, we are looking like we are, well, to me, we're looking like we are within we have established the lower side of our range, and we will just in a meandering fashion grind our way to the top of the range. Maybe we just break straight through. Maybe we come back test the middle of the range, just hang around in the top of the range for a week or a couple of weeks, as in i.e. the top half of the range, before potentially break into the upside, unless obviously we tire out those medium time frame stochastics. But the longer time frames are still looking good as well. That is kind of what I'm seeing. It is a combination of TA and FA with what I was just talking about, with just the wider picture of what's going on. Ultimately, everything is liquidity driven, and they can't pull liquidity. They can't pull the rug out from underneath an economy that they can't pull the liquidity rug out from underneath of an economy that they've already pulled the rug out from underneath the actual real economy. So the real rug they pulled out underneath the economy, and it is in a mess. And they can't now pull out the liquidity rug from under that also. Otherwise, we are literally going straight to depression level scenarios. Like within months, basically, it would be an absolute train wreck. So yeah, there is your optimistic picture of the financial situation. Apologies for this video being 20 minutes long. Well done to anybody that's stuck through. But yeah, thanks for listening. Remember, this is not a financial advice. I'm not a financial advisor. Always do your own research, and I shall speak to you guys soon.